Okay, let's dive in. So you're thinking about maybe putting some money into global equity ETFs this August. Seems like a plan.
Mm-hmm.
But what if the calendar itself had some, I don't know, hidden clues about how the market might behave?
Exactly. And that's what we're digging into today. We're looking at the historical seasonal patterns for, the big ones, S&P 500, NASDAQ 100, and the European STOXX indices.
Right. So the mission here isn't crystal ball gazing, definitely not predicting the future.
No, absolutely not. It's more about extracting these interesting insights from history. What do the market tides tend to do?
And we want to show you what history suggests, especially for this late summer, early autumn period. If you're considering investing right about now.
Precisely.
So looking across all this data, decades of it, what's the first thing that really jumps out? Is there a big picture trend?
Yeah, there really is. The most obvious finding, and it's statistically significant, mind you.
Meaning it's not just random noise.
Correct. We see this consistent period of, let's say, weakness and definitely higher volatility kicking off in late summer. And it stretches right into early autumn.
And August, you mentioned, is sort of transitional?
Often, yes.
Yeah.
It kind of sets the stage for what historically has been the trickiest time of year for stocks.
Okay, trickiest. So which month really earns that title? The main one we should be aware of?
That would be September. Hands down, it consistently shows up as the weakest month on average.
For both U.S. and Europe?
Yep. For both U.S. and European markets, it's almost got this notorious reputation.
Okay, let's zoom in on the S&P 500 then. It's got that long history, back to 1950. You said August is often flat or slightly down, but September, it's literally the only month with a negative average return over, 70-plus years.
That's the stat. It really stands out.
Now, this makes me think of that old saying, sell in May and go away. A lot of people have heard that. Does the data actually back that strategy up?
Right, it's a classic. But here's where the data gets really interesting. While, yes, the May to October stretch is weaker overall than November to April,
Okay.
it still averages positive returns. And the difference, if you just stay invested, it's huge. Let's say you put $1,000 in the S&P 500 back in 1975. Just buy and hold until now, 2024. That $1,000 grows to over $340,000.
Oh.
Now, if you tried the sell-in-May strategy over that same period, you'd end up with just over $64,000.
That is a massive, massive difference. Really shows the power of staying put versus trying to time things.
It really does. Timing the market is incredibly difficult and often costly.
Okay, while we're talking seasonal quirks, what about the Santa Claus rally? Is that one real or just folklore?
Oh, that one shows up in the data, too. It seems pretty persistent. Those last 5 trading days of December and the first 2 of January,
Yeah.
they average about a 1.3% gain for the S&P 500, historically speaking. So, yeah, that one seems to be a real anomaly.
Interesting. So September is the market's grumpy month. Does this same pattern, this late summer slump, apply to the NASDAQ 100, the tech-heavy index? Since 85.
It does, absolutely. And often you see that weakness even more pronounced in the NASDAQ. September is typically its weakest month as well.
Any reason why it might be amplified?
Well, part of it could be its concentration, in those big tech names, the Magnificent Seven and others. They can be really sensitive to shifts in macroeconomic sentiment, like what people think is going to happen with interest rates.
Ah, okay. That makes sense. And this isn't just a U.S. thing, right? What about Europe? The STOXX indices.
Good point. Europe, historically, shows an even stronger vulnerability during this August to October window.
Really? Even more?
Yeah. And remember, sell in May. That saying actually originated in London in the UK.
Ah, I didn't know that.
And studies have found this effect is particularly robust in European markets. We're talking statistically significant in like 36 countries, with UK data going way back to 1694.
Wow. Any cultural factors possibly at play there?
People often mention things like, extended summer holidays in Europe, potentially leading to thinner trading volumes, less liquidity. Maybe August really is getaway time.
Okay, so these historical patterns, they're definitely compelling. There's data behind them. But the big question for you listening now, considering investing, should you use this to try and time the market?
Right. And the answer there is a pretty strong no. While this context is valuable, using it as a market timing tool is, frankly, a bad idea.
Because of that buy and hold difference we talked about.
Exactly that. Long-term, buy and hold has historically crushed market timing attempts. And think about this. Missing the market's best days is incredibly costly. They often happen unexpectedly, sometimes during volatile periods.
They're costly?
Missing just the 20 best days over 50 years could slash your final return by like over 74%.
74% just from missing 20 days. Ouch.
Yeah. And another thing, once these anomalies like the old January effect become widely known.
People try to trade on them.
Precisely. And that very action tends to make the anomaly disappear, gets arbitraged away.
So, okay, timing is out. How should you, the investor, thinking about August, use this historical map then?
It depends a bit on your time frame and your tolerance for bumps in the road.
Mm-hmm.
If you're a long-term strategic investor, thinking 5 years out or more, our advice is generally stick to your plan. Proceed with your investments. See this potential seasonal dip as just short-term noise in a much longer journey.
But what if you're more tactical, maybe more sensitive to those near-term drops?
Right. For that kind of investor, a dollar-cost averaging approach makes a lot of sense. Instead of putting all your capital in at once, deploy it bit by bit over, say, August, September, October.
So you spread out the risk.
Exactly. It's smooth at your entry point, mitigates that timing risk, and actually lets you buy more shares if the market does follow the historical pattern and dips.
Okay, let's wrap this up. So history gives us valuable context. It suggests a higher chance, maybe, of volatility and weaker performance between August and October.
Yeah, it's like a potential headwind based on past averages. But, and this is key, it's only probabilistic. It's not destiny.
Right. Not set in stone for any given year.
Absolutely. The market's real long-term driver isn't the calendar page flipping over. It's fundamentals. Economic growth, company earnings, innovation.
So the final thought for you to chew on.
Yeah.
You've got this data-driven map of historical tides. How will you use that context wisely to inform your own strategic journey without getting caught up trying to chase every single wave?